We are currently 1 week away from the 3 year mark of my dividend portfolio, where I've been doing this for 3 years, and I've noticed a problem in the last year. My portfolio has been underperforming the S&P 500 when it's doing well growth wise. And this was okay in the first year in 2022 when the stock market was going down and mine was doing better. But then once the market started having good growth, my portfolio was underperforming. So that is something I'm trying to address now. There's a new president, Donald Trump, and this presents new opportunities to change up my portfolio. I got 4 years of somewhat predictability that I can make assumptions on, and this is 4 years I could potentially outperform the S&P 500. So I've decided to do another portfolio recomposition. The same goals as last time. Basically, kind of just want to have less positions, more money in each position, and focus more on growth. But I also want to keep up my dividends. My dividends are still very important to me, but I also want to make sure I'm targeting growth as well. My thought process is all stocks have all the news, all the data already priced into it at all times. So you're never going to outsmart the market in that regard. But what I can do is take assumptions that Trump has historically uh, gone through and assume the same things are going to happen or similar things are going to happen and just invest in those industries. And hopefully I will outperform the S&P 500 as a whole by doing that. So what I try to do is look at my portfolio through a more qualitative lens than a technical one. And I was able to come up with a couple key factors that influenced all the or most of the changes in my portfolio, at least the ones I made for Trump's term. By the way, if you never watched any of these videos before, my name is Jack Murphy, and this is, like I said, around my 3 year mark of investing and talking about it on YouTube. And I want to put two disclaimers before I start going into what sectors I think will do well and my stock picks because of that. One, I'm just a college kid who likes stocks. I'm not a financial professional. I'm not Warren Buffett. I don't know what the stock market's going to do. These are just my opinions and predictions. And number two, I am making this video. I did put Trump in the thumbnail because I'm making these picks based off of Trump's policies, but I'm not trying to say I support or don't support Trump. I'm not trying to argue about politics. I'm just saying these are the policies that are going to affect our markets, and here's how I'm investing accordingly. So, any politics talk in the comment, I'm probably just going to ignore, but I won't delete because that boosts engagement. But I'm not going to argue politics. I'm not trying to put a political opinion out there. These are just policies that are going to affect the stock market. So I'm paying attention to them. So now let's move over to the sectors I think will do really well under Trump. And I'm just going to go over why I think each sector will do well. And then I'll call back to them when I'm going over my stock picks, just so I don't have to repeat myself and explain everything for every stock buy and sell. So firstly, I think oil and gas will do really well. I think banks and financials will do really well. And I also think tech companies can do really well. And I'm also betting on real estate to do well. I think these four sectors specifically cover a lot of bases, and a combination of these can make a really good portfolio. And I'm also going to talk about tariffs, which isn't a sector of the stock market, but it is influencing a lot of these sectors and a lot of my picks. So I'm going to also talk about what I think the effects of the tariffs are. So let's move first into oil and gas. Trump has shown that he's pro fossil fuels and he wants U.S. energy independence. So both of those factors, I think, will make it likely that policies that are pro oil and gas or good for the oil and gas companies will come out. He also is in support of deregulation, which hinders oil and gas companies, so they will have less burdens going into the next 4 years. And he's also about corporate tax cuts, so once again, less of a burden on the companies. So that's why I think oil and gas stocks can have a favorable environment in the next 4 years. It is also important to note that Trump's policies are not the only thing that affect oil and gas stock prices. It's a global market and has many factors, but I think Trump is the more predictable variable, so that's what I'm basing this decision off of. And I'm also buying American oil companies. So that is why I'm making this pick off of Trump policies. The next sector I think will do really well is the banks and financial sector. Once again, Trump is all about deregulation, especially in the finance sector. So I think that's more favorable for those companies. Corporate tax cuts could also help them, obviously. If you're paying less taxes as a corporation, that's more profits. And the tax cuts for other corporations could incentivize borrowing money, which again helps the banks. Under Trump's administration, interest rates are likely to go up, which is favorable for banks because they're making a higher interest on the borrowed money they're lending out. So that's another reason the banks could do well under Trump. The next sector I want to talk about is tech, but it does actually have some conflicting pros and cons with the banks. So I'll go over that. Like I just said, the high interest rates could be good for banks, but it wouldn't necessarily be good for tech companies because then to borrow money, they have to pay more interest, which could be a problem. But the tax cuts are once again good for all corporations, especially those tech companies that are making a lot of money but getting taxed a lot. Also, deregulation will make it easier for the tech companies to operate, less hurdles to go over, more money you can make. Most of the tariffs are affecting big countries like China that also make a lot of tech. So, getting less Chinese tech brought into America could mean that more US tech will be sold in the country, at least domestically, so they can make more money there. But it is also worth noting that these tariffs do hurt the tech companies a little bit in the sense that if you're ordering a lot of parts from China or other companies affected by tariffs, that's more cost for the tech company to manufacture their products. So it goes a little bit both ways for tech, but I also think US wants to be competitive in this AI race. So I think a lot of money is going to be invested into these tech companies to keep producing more advanced AI. I think tech is still a profitable industry to invest in because it's very important for us as a country. So the next area that I'm talking about is real estate, and I'm also going to cater this real estate to realty income because that's my real estate exposure in my portfolio, and I didn't buy any other type of real estate stock. So, firstly, Trump historically has focused on investing domestically and on our infrastructure, which would benefit uh, real estate in the United States and commercial real estate. REITs, Realty Income is a real estate REIT, and they have to pay about 90% of their taxable income as a dividend. So corporate tax cuts could really help them have more profit to work with because that has been hindering growth for them. So that's an opportunity where they could get some capital gains instead of just paying out those dividends. Real estate's also kind of an inflation hedge because property values can keep going up, and real estate income has written up in their leases that they can increase rents as inflation goes up, so they're not going to lose money to inflation on their leases over the next 4 years. And real estate is typically, or realty income has been historically stable. They pay good dividends. So I'm not taking a huge risk. This feels kind of like a hedge in my portfolio to give me some stability and potential growth, while the other sectors are a little more growth focused, at least over these next 4 years. Trump's immigration policy also could factor into this. Typically, a lot of immigrants work construction. If there's less workers to work in construction, we're getting less real estate built, which means a lower supply and demand will keep going up. So supply and demand, property values can go up. I think overall, real estate's going to keep getting more expensive. If you own real estate, that's probably good. If you're trying to rent, that's probably bad. Rent's probably going to go up. Inflation, I think everything's going to get a lot more expensive. So that's why I want to have some real estate in my portfolio, even if it's only in the form of a stock. So these are the 4 sectors I'm having most of my portfolio in. I think it's a good combination where they cover all likely bases, and my portfolio can probably do pretty well over the next 4 years. Obviously, when I say something like interest rates are probably going to go up, I don't know that as a fact. I'm making an assumption. These are a lot of assumptions, so don't take all my words as definite facts, but I think they're good assumptions. I also want to talk about tariffs because that's affecting a lot of my stock sales as well. Tariffs could increase domestic sales because it's probably cheaper to buy domestically when there's tariffs, but companies that rely on imports are going to be affected negatively because their costs are going to go up and could get passed down to the consumer. And also, companies that do a lot of international business could be affected because when we put tariffs on other countries, they're likely to put tariffs back on us, causing a trade war, which would mean if you're a company that does a lot of international business, you might lose sales when these opposing countries put tariffs on us. Tariffs can also increase inflation, which raises interest rates, which affects some of the other industries I was talking about or sectors. So that's another factor of tariffs. So that was like the foundation information for all my decisions. Some of these companies have more specific reasons, but that's the main reason for all my sells and buys. I also want to mention that I don't think any of these companies are necessarily bad, but I'm trying to optimize my portfolio for the next 4 years, and I think there's more better opportunities in the sectors I talked about. So these are all companies I could definitely see myself revisiting in the future, but I have my reasons for selling them now. We'll start with Pepsi, Procter & Gamble, and Johnson & Johnson. I just put these three together because they're almost all the same reasons I sold them. They do a lot of international business, which, like I said before, could be affected by tariffs. Cost of imports increases their costs. Trade wars, tariffs on us by other countries could reduce their sales. Probably not a good environment for them specifically. Rising interest rates and opportunity cost. You would be safer getting a bonds than investing in like a stock that gets low dividend returns. So that could hurt these three companies. Pepsi, I did about minus 3.8% or minus $10, which kind of hurt. It was kind of a stinker in my portfolio, just wasting space. Procter & Gamble, I did pretty good. I got at a low point and did about 25% returns, or 41 bucks was one of the smaller investments in my portfolio. And Johnson & Johnson, I got about 9% returns overall, and this was about 69 bucks. By the way, these all include dividend payments too. So not terrible returns from the last two, but lacking compared to some of the other stocks in my portfolio. And overall, I did say I would revisit these companies, but I might hold off on these ones for a while because these are better retirement stocks. I got a lot of years to grow my investments, so I think I'll stay away from them until I got some more gray hairs on me. But now let's talk about Starbucks as the next stock I sold. And this was a stock I was buying pretty recently, like just a couple months ago, I was buying Starbucks. But some things changed, and I'm kind of making a prediction that they will have slower growth for the next 4 years than I previously anticipated. So first off, tariffs, increased costs, could get passed on to customers. They do have good brand loyalty, and they probably could raise prices and keep most of their customers, but there are other factors I think that could hurt them more. Internationally, Starbucks does pretty well. If we look at China, where their most international business is probably being done, I think they're going to lose a lot of their sales in China. Once again, the tariffs, China and US will have some trade wars. I think China is becoming less accepting of US companies. I recently found out about this Chinese coffee brand called Luckin. I think I'm saying that, Luckin. And it's basically the Chinese Starbucks, and it's growing pretty well or pretty rapidly in China, taking over a lot of Starbucks market share. So I could see Starbucks and other US companies losing a lot of the market share in China where they previously did pretty well. And now we'll kind of just look at my personal investment. I bought a lot of Starbucks at around $77. Starbucks share price right now is around $115. So I'm getting a pretty good return, and I can just lock that in by selling it now and not risk a dip. I think they had a lot of growth recently because of the new CEO, and I do think that CEO can make positive changes for the company, but I just don't think the growth from here, the growth opportunity is as good as some other industries, sectors. So I'm kind of just taking profit and leaving. The next stock I sold was Lowe's, and this is another one I could see people disagreeing with or going either way, but I'll explain my reasoning. Tariffs, once again, are increasing costs from imports, so that's something to always consider. You can also look at the housing market. Like I said before, I see it getting a lot more expensive and a lot more difficult to interact with. So if we look at the home improvement sections, but I could just see them having less sales because you're paying more money to live. You can't really get fancy with the decorations. And once again, this kind of seems like another 50-50 buy or sell stock, at least in my view. But it's once again comes down to opportunity costs. I think this money could be better elsewhere. The stock may continue to do well, but I'm just thinking I have better opportunities elsewhere. I also did pretty well. I got about 34% returns on my Lowe's investment, or about $63. So I can lock in that profit and be happy about it. The next stock I'm selling is, or the last stock I'm selling, I should say, is Texas Roadhouse. And this one has a little bit more to do with my personal investment than the company as a whole, but I'll explain. First off, labor and food costs have been going up. Yes, corporations are getting tax cuts and whatnot, but for the restaurant business, I think that might hurt them. The labor and food costs might hurt more than the tax cuts help. They obviously balance each other out, but I think that's an area that's going to be harder to grow. And also, real estate costs are going up, I assume, or I'm thinking. So, by that logic, it's harder for this company to expand, harder for them to grow, less growth opportunities, less opportunities to increase revenue. Recently, Texas Roadhouse has had a pretty good jump in share price. I bought, I think, over a year ago, maybe a year and a couple months ago, I bought Texas Roadhouse at around $100 a share. It hit recently $200 a share and now pulled back into the high 170s. Oh, that's a pretty big jump in share price for such a short period of time. And my investment did pretty well. So I'm up about 75%, or roughly $160. So I feel that there's not a ton more upwards opportunity in the next 4 years for Texas Roadhouse. And I think I should just lock in my profits now. If it goes up a little bit more, that's great for them. But I'm happy taking my profit here and redistributing it elsewhere. So that's kind of why I sold Texas Roadhouse. So after all those sells, I have about $2,396 of cash in my portfolio. And here's how I redistributed it. Firstly, I put $400 into JP Morgan. Basically, the reasons I said I wanted to bank stocks, that's why I put more money into JP Morgan. And that brought my position to about $1,088.21. The next stock I bought was Chevron, oil and gas. The reasons I said before. I also put $400 into Chevron, bringing my position to $1,042.50. I also bought Microsoft. The reasons I was interested in the tech industry, Microsoft, put about $300 into Microsoft, bringing my position to $619.33 roughly. Also bought more Amazon. Same reasons as the tech stocks. I also think it's a little bit more undervalued than some of the other tech stocks. So I put another $200 into Amazon, bringing my position to $701. Real estate, I put about $160 into Realty Income. The real estate reasons I said before were mostly directed to Realty Income specifically, but also real estate as a whole. And the reason I only put $160 into this one is because I already had a good position. So that $160 brought my position to $1,005. And I don't want to go too crazy on this one stock. So I'm not going to be adding too much more aggressively to Realty Income. I like the position where it is. So those were the industries I talked about before, but there are also other stocks I bought or I put more money into. I put another $266 into Regeneron, bringing my position to about $1,262. I've talked about it so many other times in the other videos. I really like the drugs they got in development. I think they're oversold for the missed earnings they had a couple months ago or the last few quarters. And I think it's a good long-term opportunity, not specific to the Trump administration. This is just a long-term stock I like. They also recently added dividends, which is pretty cool because they were just a growth stock until they added dividends in February. So pretty cool for all the dividend investors who have it. If If you want a deeper explanation about Regeneron, just go watch some of my older videos where I talk about that. Another stock I bought was Altria Group. Altria Group is a tobacco company, and no matter what happens, tobacco demand is pretty stable. So I feel like it's another safe, stable stock I can add to my portfolio. They have a really good dividends at over 7%, and I like my dividend stocks, so this gives me good dividend exposure. Trump is also all about tax cuts, like I said, for some of the other sectors, and this would help tobacco company. He's also about deregulation. So tobacco industry is usually hurt by like regulation and taxes and tobacco specific taxes. So I feel like it's less likely that that will happen under Trump's administration, giving them a little more breathing room and a little more chance to make profit. And Altria Group is also making a lot of investments in reduced risk products. So these are like the vapes and other forms of nicotine. And I think these 4 years, they have comfortable room to develop these investments, see if they can turn them into something, while their tobacco sales can be pretty good. And then by the end of Trump's term, I can come back, reevaluate Altria Group, see if these investments paid off and I want to keep investing in them, or if I want to just take profit near the end of his term and be good with that. I put another $300 into Altria Group, bringing my position to about $843. And lastly, I put $370 into SCHD. This is just the Schwab Dividend ETF. I keep a good percentage of my portfolio in this ETF because it is just really amazing, pays really good dividends, keeps up growth-wise, and this brought my position to about $2,018 in my Schwab Dividend portfolio. Pretty happy with that. I also think it's important to mention that in my Roth IRA, I keep it 90% ETFs, and the Roth IRA is over 50% of my total investments. You see me making all these strategic and maybe flashy stock picks in this portfolio, but I keep it really simple in the Roth IRA. I keep VOO, which is the S&P 500, QQQM, which is just a growth ETF, SCHD again, which is the dividend ETF, and then I do have about 10% in Regeneron, which is just 10% I play around with, and I think that's a good long-term stock pick. Basically, wanted to say, you hear me talking a lot about my stock picks, but less about my ETFs because there's less to talk about. I just want you to keep in mind it's always good to have a good percentage of your investments in the ETFs that are a little safer, more stable, and smarter long-term investments. And then you can take a smaller percentage of your portfolio and try to make these maybe shorter-term presidential swing trades or shorter term trades than those ETFs. So those are all the buys, the sells, the reasoning. Now let's go over my new portfolio makeup. So we can look at all the holdings. About 21% of my portfolio is in SCHD now. I have about 13% in Regeneron. I have about 11% in JP Morgan, about 10% in Chevron, about 10% in Realty Income, about 9% in Altria Group, 7% in Amazon, 6.43% in Microsoft, 5.5% in Visa, and then about 5.5% in Main Street Capital. The reasons you didn't hear me talk about Visa or Main Street Capital is because I didn't buy or sell any more of them. Visa was already a big position in my portfolio, and I wanted to prioritize everything else first. But Visa stock, I'm going to be continually dollar cost averaging in as well in the months to come. I just didn't do a chunk today or in this reallocation. And Main Street Capital, a couple days ago, I kind of got feelings that this might be a stock I might consider selling. I'm not sure about it. It's probably going to take me a couple weeks to finalize any decision, but I didn't want to wait on this video until I made that decision. So for now, it's in the portfolio, but I may or may not reallocate that money. But as you can see, a lot of money in JP Morgan, a lot of money in Visa, the financials, a lot of money in Chevron, the oil and gas, Realty Income, the real estate, Altria Group, that kind of hedge stock, Amazon and Microsoft, about 13%. I think that's divided up pretty well. We look at the sectors, 25% financials, healthcare, 16.5%, energy, 13.48%, consumer staples, 11.9%, real estate, 10.5%, consumer discretionary, 9.5%, information technology, 8.67%, and then we got industrials, 2.5%, and communication services, 0.92%. I think that's coming from the ETFs and not any individual stocks. But that's the overall breakdown of the portfolio. So that's the new and improved portfolio. I feel like it can do really well these next 4 years. Obviously, you have to wait and see. Obviously, this is not how it's going to be looking like exactly 4 years from now. I'll, adjust when new information comes out, but I think this is a good starting point for the beginning of Trump's term, and we can adjust from here. Lastly, do not forget the dividends. What are the new dividend stats? You may have heard that my dividends actually went up in this reallocation, even though last time they went down. So what's that about? Well, the new dividend yield is 3.05%, which means I'm now getting $291 a year from this portfolio. Really close to that $300 mark. That's going to be a cool milestone. But yeah, it went up. It was at around $264 a year before. So about a $30 increase, which I wasn't actually expecting, but I'm pleasantly surprised from. Sorry, my light just died, but my next video coming out is my 3-year update video, so stay tuned for that. If you want to check out my old recomposition and see what I changed from there, I have that video linked up here too. So thank you all for watching. Peace.